For almost 2 years, the economy of Germany has been suffering. Big companies and entire industries are leaving the country. We are talking about iconic brands everyone knows. Michelin Tires is ending production by 2025. Two factories are closing down with over 1,500 jobs going away. The reason? A higher cost of production. Oil companies like BP are reducing their refinery operations as well. The reason? A higher cost of production once again. Throughout Europe, we are seeing industries getting decimated. One of the biggest sectors is the petrochemical industry, and this is where oil gets processed into products that find their way into plastics, medicine, and even solar panels. Once again, these industries are collapsing because of energy costs. Europe's consumption of naphtha, a petrochemical feedstock, has fallen to a 50-year low. Higher energy costs have caused the death of this industry. He has regressed back to the levels in 1975. This is even more clear looking at the trade surplus of chemical products. Europe, especially Germany, used to export a ton of chemicals to the world. However, the surplus of 40 billion euros has fallen dramatically to under 3 billion. That's a fall of at least 90%. Europe is no longer a major supplier to the world for chemical products. But guess who is? It's China today. The production loss in the Eurozone is being transferred to Beijing. It's a really simple equation. A cheaper manufacturing base translates to a lower price tag, so demand goes up. Just in propylene alone, China is expected to add 4 million tons of production by June 2024. They are adding so much that prices are starting to fall. Once again, this is a classic Chinese strategy. They're exporting deflation to win market share, and this is the result of the global reshuffling of the Russia-Ukraine conflict, especially the blowing up of Nord Stream. Global demand is flowing to China. With increased demand comes job growth and rising profits. Because China gets cheap fuel from Russia and Iran, they can fight a price war with the rest of the world. Germany is beginning to face this reality. Even though the Bundesbank and Olaf Scholz they want decoupling, German companies are pushing back. They are fighting for survival, and this next move tells us the truth. Olaf is heading to China and he's bringing the biggest German CEOs along. Despite the narrative, brands in Germany can see the writing on the wall. If they can't bring down the cost of manufacturing, it will be the entire companies that will topple down. And this delegation is quite impressive. We have Siemens, Merck, and Bayer joining. Automakers like BM and Mercedes-Benz will be heading to Beijing as well. During the meeting, we can expect the same song and dance. Olaf Scholz will push for de-risking and join in the US in scolding China for overcapacity. But the fact his delegation is filled with all the top CEOs tells us the urgency in the German economy. Companies fleeing to China shows you who has the true power. It's not Berlin, but Beijing. And when we think of Chinese manufacturing, there's still a big misconception around, especially in the West, that China is relegated to making cheap plastic toys and low quality TVs. Made in China is still a term people use to mock Chinese products, but that isn't really the case. They have climbed up the supply chain so fast that it's really frightening. If Beijing can manufacture both cheap and sophisticated products at a competitive price, it's all over for industries in Europe. And that's why we are seeing this delegation of German executives to China. The Volkswagen CEO has given up. He has declared defeat. China's EV competition is so fierce that Volkswagen can't keep up. We are witnessing a quantum leap in the cost of manufacturing in EVs. And here's how insane things have gotten. China is waging a price war on the competition. They are throwing around discounts of up to 20% to steal away market share. The strategy is to make EVs so cheap that buyers ditch their petrol cars and go electric instead. Then they are locked into the BYD ecosystem and become customers for a very long time. From spare parts to charging stations, the entire network is owned by the Chinese company. And this is a direct consequence of the energy crisis. China saw this chink in the armor and they went after it. I'm sure German brands have better marketing and history behind them, but prices do matter and they matter a lot. Countries like France are trying to impose barriers to Chinese goods. The finance minister is trying to restrict Chinese trade because they simply can't compete. Instead of competing fairly, France wants to lobby the EU to rebalance trade based on environmental criteria, so goods from China aren't welcome because they aren't green enough. We risk leaving behind a wide open path into the EU single market for goods that don't respect environmental rules and don't have the same cost of production. The ruling class isn't happy with China's price war. but it's important to look at what the companies themselves are doing. Why are German brands setting up shop in China? The numbers really don't lie. Foreign direct investment in 2023 has reached a record high. Nearly 12 billion euros have been reinvested back in China. Based on this chart alone, it shows the big dependency German firms have, and we can expect this number to stay strong or even grow in 2024. While Scholz can definitely block Chinese exports, German companies want to sell into the Chinese market. The country is moving towards a model of domestic consumption. The Chinese consumer is going to drive the economy. In 2023, over 80% of GDP growth came from domestic consumption, and this was during a period immediately after the lockdowns while property prices were collapsing. German companies, they understand the potential of the Chinese market. Over the next 5 or 10 years, the market potential will be enormous, but to grab market share locally, you still need to compete on price. Brand power alone won't be enough. So we'll continue to see German companies relocate to China. Setting up shop there is mission critical. One half is to export cheaper stuff, the other half is to sell more stuff to the local Chinese. This brings us to Yellen's trip of desperation to Guangzhou. Before the trip, she warned China of overcapacity, the fear of Beijing exporting deflation to the world. And during the trip, she delivered an even bigger warning. She wants China to cut away trade with Russia. She warned the Chinese minister of significant consequences if companies support Russia's war in Ukraine. Now, this is a very slippery slope because what really constitutes support? Is it restricted to weapons? Is buying Russian oil a form of support? How about supporting Russian banks with yuan transactions? So you can see how big of a problem this really is. Now, material support is extremely vague. The scope can always expand. It might be dual-use goods today, but tomorrow it could very well be China's imports of Russian energy. In a recent call with President Xi, Biden himself raised concerns over China's support for the Russian industrial base. The support includes machine tools, optics, electronics, and turbojet engines. And this, once again, is a very broad range of products. They're essentially dual-use exports that can be used in and outside the military. What the US wants is for China to starve the Russians out and hurt their own economy as well. You can tell how bizarre this is, especially when the West is looking to buy weapons abroad to fight against Russia. China isn't providing weapons, they are simply trading with the Russians. I think this underscores the big urgency Europe is facing. Their money is drying up and raising further funding is going to be extremely difficult. All the options are bad with serious repercussions. There's the Russian reserves plan. They can reach in and use the profits, but that will undoubtedly unleash a financial backlash. It will drain away any trust left in the Western system. NATO recently made a $100 billion proposal for Ukraine as well, but it seems they are walking back on this as well. NATO members are warning against making promises they can't keep. It's obvious Europe is reaching their limits. The Russians are pumping out even more ammunition than ever, but coughing out more money is simply impossible. Putin's not giving Ukraine a breather either. Ukraine's running out of ammunition, but that won't trigger negotiation. Putin made that abundantly clear. So the only alternative left is to pressure China to cut away trade with Moscow. And here's the big problem. Russia has managed to survive the G7 sanctions, especially the ones on their top export, oil. Despite the price cap and despite the refinery attacks, revenues are not collapsing yet. Putin's earnings from energy nearly doubled in March. Ever since the price cap in December 2022, oil revenues have picked back up. It's the third highest month since the start of the conflict. This is money funding the war machine, and there's no risk of Russia going broke. They have the industry to keep churning out weapons and money to support production. Primary sanctions have essentially failed. So the only option left is to target Russia's trading partners, and the biggest one by far is China. Trade between Russia and China is existential. We must look beyond just this war. It goes much deeper than Ukraine. What China is trying to do is build a self-sufficient economy independent of the West. It should be very obvious today. Selling treasury bonds was just a start. Investing in the Belt Road was a big sign as well. But self-sufficiency for China is impossible without Russia. Trade with Russia reached a record $240 billion last year, and in 2024, this number will continue to climb. Russia essentially provides the raw materials while China supplies finished goods. If the West continues to decouple with China, it's unthinkable for Beijing to stop trade with Russia. It's not a coincidence that Russia supplies China with nearly 20% of their oil imports. China's just next door, so they can get cheap oil from the pipeline. and that lowers manufacturing costs and allows China to export deflation to the world. Europe's advantage has flowed to China, and that's why they are so frustrated, why they are so angry with Beijing. Another big reason is to export their products. The Russian economy isn't collapsing. It's heating up to the point that the central bank has to keep interest rates high to prevent higher inflation. In the first 2 months of the year, their GDP grew by 6%, and that's rather astounding for a country under a ton of sanctions. That's even faster growth than the US, Europe, and even China. The only economy growing faster than Russia is India. And listen to this, household incomes and borrowing are increasing, savings are also increasing, and that coincides with investment growth and a stable financial position. And if you put two and two together, it will be crazy for China to cut trade away with Russia. Consumers there are strong, and China still needs an outlet to sell their products. The West could always sanction China directly. I mean, it's not impossible. And if Beijing cuts trade with Russia today, they will torpedo their own economy. So Yellen traveling to Guangzhou is a complete waste of time. It's a wasted trip. It doesn't make sense for Beijing to decouple with Russia. In fact, trade between the two countries will keep growing. Putin is moving to boost his railway capacity to Asia. Russia-China trade isn't at its full potential yet. The Eastern Railway still has a ton of logistical issues, and Moscow is going to build this up. The demand for Chinese goods is there, but the infrastructure simply can't handle it yet. In 2024, capacity was at 180 million tons a year, but this is going to rise above 250 million tons in a decade. That's a 40% increase in trade potential between Russia, China, and the rest of Asia. Decoupling with Russia now will be an existential mistake for China. It will be one of China's biggest mistakes. Think about it from China's perspective. If I end trade with Russia, I lose a geopolitical ally, a supplier of cheap energy, plus a growing economy to sell into. And if I cut trade to appease the Americans, the West, that won't change anything at all. China is the next target of the US, and the desire to contain Beijing won't suddenly disappear. The economic war between the West and China won't end. It's only going to get worse. We know the US has slapped a ton of tax sanctions on Beijing, but AI chips and machines are just a start. Washington might be weaponizing the financial system once again. US lawmakers are proposing sanctioning US index funds that invest in China. So an ETF that has Chinese companies listed could be punished by the US government. Funds like Vanguard could get punished for offering people a chance to invest in China. And I must say, this is absolutely crazy. The idea here is to drain away investment to China, to damage China's capital markets and shift investor money back to the US to prop up the US market at the expense of China. So there you have it, the future of US-China relations. China can't cut trade away with Russia without enormous risk to itself. And what the West is doing is pushing these two powers closer together. But let me know what you think. Can Germany ever decide to decouple from China? And will China cut away Russian trade just for Janet Yellen? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.